Hi, I'm Myles, founder and CEO at Flying Colours. In each of these videos, I talk about themes that matter when investing your money. Today, we'll look at the relationship between the economy and the stock market, and why they don't always move in the same direction. We know that a healthy economy is important for a healthy stock market over the long term. Individual companies can do well, but it's hard to grow revenues and profit across the market if the underlying economies that the companies serve are weak. That said, it's a common misconception that poor economic growth over shorter periods means stagnant markets. It really depends on the circumstances. Let's take GDP as a measure of economic growth. Over a 20-year period from 1994, the correlation between the economy and stock market performance in the US has been weak. This is because the market has grown much faster than the economy. In fact, stock markets often outpace the broader economy in many regions. But that's not a rule. A growing economy doesn't automatically guarantee market growth. For example, China's GDP has grown 35 times since 1994, but its stock market has only grown 5 times. Why is that? The rationale is that China's strong GDP growth has been driven by companies which aren't on the stock market. Therefore, it's fair to say that Chinese companies have not prioritised profit growth in the same way as those in other parts of the world. More recently, other factors have become important. Market volatility, along with concerns over government intervention, have caused investors to worry, and this has led to China's stock market lagging even further behind its economic growth. So why can there be a disconnect between economies and stock markets? First, the economy isn't just the stock market. While the US dominates global stock markets with 66% of listed companies, the global economy is much broader and more heavily weighted towards emerging economies. Another reason is that companies listed on stock exchanges don't represent an entire economy. In the UK, for example, 44% of GDP comes from the public sector, which doesn't operate for profit. Some countries have a large proportion of privately owned companies that impact the economy, but they are not on the stock market, so you can't invest in them. Beyond the economy itself, investor sentiment and speculation can drive stock prices independently. A recent example was during the global pandemic, where markets rose even as economies were shut down. It was investor optimism for a post-pandemic recovery that was important. And certain sectors like technology can also outperform the broader economy due to innovation. As you can see, while GDP and stock markets are related, they don't always move in sync. As ever, if you have any questions about today's video, please get in touch. Just email hello@fcadvice.co.uk. Finally, I've been talking about investing, which means that your capital is at risk. Thank you for watching.